Welcome back to The Exchange. Data this week showing signs that the housing market could finally be cooling a bit. And I'm seeing more for sale signs, just anecdotally. New mortgage demand fell last week. Builder sentiment dropped in April for the first time in 7 months, as did both single and multifamily starts. And just today, Reuters is reporting one regional bank reducing its exposure to the apartment space as commercial real estate headwinds persist. WaFd, Washington Federal Bank, agreeing to sell its portfolio of 2,000 multifamily real estate loans to Bank of America for nearly $3 billion. But my next guest says it's not all bad in the commercial space. Joining me here on set now is Don Peebles. He's the chair and CEO of the Peebles Corporation. It's great to see you. Welcome.
Thank you. Good to be here.
I feel like it's a good time to check in and say, where are we on the commercial real estate, drumbeat of the last couple of years? Where do things stand?
Well, I think there are a couple sides to it. So the lending side is challenging because these regional and local banks have a tremendous exposure to commercial office buildings, and those office buildings are in trouble in most of the major markets around the country. But then when you go to the housing side of the equation, it's supply, not enough supply, so that keeps prices up. And places like Florida, which has been really strong, are beginning to pull back a little bit, but not that much. But of the major markets in the United States, the 50 major metropolitan markets, 93% of them are showing price increases.
In rents and residential?
Rents and mainly in home prices.
Yeah.
And so we're going to keep seeing that because we're in supply-constrained markets. And now with the credit crunch that's happening, it's harder for builders to finance new construction. And it's hard for buyers to qualify now for the home that they would like to own because interest rates have more than doubled.
Yeah, absolutely. So I guess the larger question, and I understand why people have pulled back on the space, but is where do you see opportunity? Where do price dislocations or maybe a dearth of lending or kind of what pockets of opportunity are there right now?
Well, I think the number one opportunity is private credit. Private credit was playing a big role in commercial real estate. Since the regulations changed to the third Basel Accord in terms of discouraging banks to make high volatility commercial real estate loans or development loans. And so private credit has stepped in before the pandemic. And now with interest rates more than doubling and banks in no position to make loans, private credit is having a great opportunity. You're getting good quality product to make loans on, getting well paid for them, and you don't have a competitive environment as much. And so I think that's the top space, and that's a space we just entered into a few months ago. Okay,
because some people were saying, this is an area of concern. It's kind of a shadow market, if you will, where there could be problems brewing down the road, maybe looser underwriting standards. You're not worried about that? Or maybe it just depends on the quality of the lender. Yeah,
well, I think also that it's different. Banks, when they make loans, those loans are underwritten by a formula. Private credit does it on a more individual basis, so you can make a better decision. And firms like ours, where we are in the real estate investing and development business, it makes perfect sense for us to be able to underwrite them better because we know the business. So I don't think there's a systemic risk there. I think the banks thought they had this security because they were under leverage, but in reality, they're so heavy on commercial office buildings, they're in trouble.
Yeah, absolutely. We've talked in the past about San Francisco,
yes,
and that being an area where you said, hey, listen, the tide might be starting to turn, and I would be curious if we kind of checked in on that front. And Boston as well sounds like one place where you're saying, hey, there's big opportunity.
Yeah, there's great opportunity in Boston. Excuse me, great opportunity in Boston. And of course, the reason why is it's a supply-constrained market. Real estate's a simple business, supply and demand. And the Back Bay, for example, where we're doing business, is doing very well because it's supply constrained.
Wow. So I know people in the past have talked about, hey, they have biotech, they have things like that. But you mentioned Florida in terms of softening. Usually people are talking about that as still booming. You think that's still the case, or is that all kind of, the story of a few years ago?
Well, from 2018 to last year, prices almost doubled in South Florida, home prices. So that rapid appreciation has slowed down. And so there's been a pullback, but people are still making big returns on their investments. And so, again, the market has been more pro-real estate demand, pro-real estate development. And so you've had a lot of inventory. The builders and developers focused on producing more product and more supply. And so you have a little bit of an imbalance now going towards the buyer side. So there's more supply than there is demand, and the demand has been cooled because of interest rates. Simple as that.
I'm just thinking through from the Fed's point of view, when in the whole debate about should they hike one more time, or is it okay to start cutting, or do they need to start cutting to support the economy? What would the takeaway be from the commercial real estate sector right now, which was one of the most concerning areas maybe 18 months ago? But now, from what you're describing, it sounds like there's private credit activity. It hasn't been enough to really slow things down dramatically, and office is challenged for its own reasons. But broadly speaking, what's the message there? Are things largely kind of doing just fine?
No. There's a kind of a calm before the storm. It's like an overcast day, but the storm hasn't hit yet. The reality is that the most 80+% of commercial real estate loans are held by local and regional banks. They have not executed foreclosure action for the most part. That's beginning to tick up. We're going to see more of those. And in addition to that, because of the risk to the capital bases of these banks, they're not making the small business loans. They're not making more real estate loans. And so what's happening now is you're going to see some job decline, and so I think, and then you're going to see significant losses in that commercial banking sector going into 2025.
Yeah, perhaps more drawn out or a little bit more delayed than we thought, but an overcast day still.
Yes.
Don, thanks very much for joining us today. Appreciate it.
Thank you.
Don Peebles with the Peebles Corp.